Hi, everyone. Welcome to our fourth quarter webcast. Today, we want to talk about what governments are tackling in the coming quarters. What is the problem that the West is dealing with? What are the policies that are going to be implemented? And then what are we doing in markets now that we are at really tight levels in spreads, risk premia, volatility, and very high valuations in equities? The problem is that essentially there is a debt and demographics problem in the West, which has been increasing over the last decades. We already know the causes. We know the consequences, the solutions that policymakers are implementing. And then we have to discuss what we are left with, which is a very overvalued market, but with some interesting opportunities, especially for alpha. Where does the problem come from? And why are we worried about it right now? It comes from low productivity in the West. Western economies have, for a very long time, imported resources from the East, from emerging markets, at very cheap prices, and then exported services. But the productivity of Western economies has eroded for a number of reasons. In particular, there's been a combination of let them eat credit policies, of short-term policies, which have not improved innovation. And also the technological gap between the East and the West has narrowed. China now accounts for 30% of production. They were 10% at the beginning of the 2000s. If China gets to 50% of global production, then of course, China in the East will be winning, and it will be very difficult to stop this advantage, whether it is with tariffs or with any other ways. So the US and the West finds itself in a narrower corner today versus 20 years ago. This has been also highlighted by the very famous report by Mario Draghi, which shows that the technological manufacturing edge between East and West is narrowing. What is the result? Well, the result is that the American dream is under pressure. Incomes are falling or stagnating. There's more inequality at the corporate level and also at the social level between the top 1% and the bottom 99%. This is very important for the amount of liquidity and spending that we see in the market. And it's the reason why spreads are so low right now. A few decades ago, in the 1960s, a 18-year-old guy or woman had 80% probability of being richer than their parents. And today, it's a 50% probability. So the result is that in an environment of high geopolitical risk, high inequality, and low productivity, the Western economies are struggling to keep up with the advance of China and emerging markets. And what they're doing to solve their problems is to spend. Milton Friedman used to say there's nothing more permanent than a temporary government program. Well, Western economies continue to spend, and we think they will continue to run high deficits the next year and in the near future. So when you have a lot of debt, productivity is low, you are not seeing populations grow, and your technological edge is narrowing, and there's high geopolitical risk. You got to keep spending. But how do you absorb all this debt? Well, in our last Silver Bullet investor letter, we talked about unsafe assets, about how demand for risk-free assets is challenging and what policies central banks and governments are trying to invent to absorb this demand. There's essentially four options on the table. If you exclude, restructuring your debt. The first option is the nicest one, which is growing, and it's AI, and it's the hope that a lot of investors are buying into. But ultimately, it will take a long time. There's also austerity, but this is a word we never hear. And so the other two options are making other people's pay, and the Trump administration is trying that, or printing money, using central bank monetary policy to absorb some of the debt. The reason why we're worried about the Western debt problem and the policymakers' actions right now in particular is that we are seeing the US administration together with the Fed, toying, thinking, discussing a lot of monetary experiments, a lot of new tools in the box. We're talking about 100-year bonds. We're talking about potential gold reserve revaluation, and I'm sure you've seen the New York Fed paper in August on it. We're talking about stable coins, bank deregulation, so encouraging, so to speak, domestic banks to buy more treasuries, or even changing the target rate for the Fed, changing the interpretation of the Fed mandate. What do all these things mean? they mean that there's going to be a looser monetary policy. And in a way, the Fed already told you that they don't really care about inflation because they do see inflation at 2.7, 2.8% in the next coming 2 years. And despite that, they're cutting rates. And we've been already above target for over 50 months. What was supposed to be transitory is no longer transitory. It's a reality. So we're in fiscal dominance. But on top of the fiscal dominance that we discussed over the past few quarters, we're seeing an acceleration in the looseness of policy, a deterioration in the Fed independence with a combination of, governors, presidents being replaced, and a new chair coming very soon next year. We do see even an acceleration on the fiscal side. So not only Fed cuts that continue this year and next year, but also more spending from the US government and other governments in the world. So the combination of monetary and fiscal stimulus has created a market that is priced for perfection. Credit spreads today in the US are at a 30-year low, and positioning, the amount of people that are long, is at a 15-year high. There are some differences across markets, but what you see here is a very expensive credit market, both in the US, in emerging markets, and in Europe, down to much tighter spread levels compared to the peak that we had in April, to the widening that we had in April. So a market that's priced for perfection, especially in investment grade, especially in US credit. There are some differences, and Europe is probably a slightly better place to be. But you generally see a market where valuations are very tight. And valuations are, a very important tenet for investing. In particular, if you look at the composition of ratings in the high yield market, double Bs and single Bs, so anything except idiosyncratic special situations is extremely tight. There's been a lot of inflows into liquid credit and into non-liquid credit, which locks investors in a long-term level of yield, in a long-term fund, in a long-term beta. So we think that here, while we don't see a reversal in the loosening of policy, in the increase of liquidity, valuations make the market skewed against investors. The downside is much bigger than the upside should something go wrong. In other words, when you think about returns in credit, very rarely the yield is the return you make. Many years, let's say 4 out of 5 years, on average, you will make something that's higher than your yield, higher than your spread, because spreads and yield will tighten, and there will be a roll down on top of your carry. There will be an additional return. But then there is a year out of those 5 where you make a lot less. Given the starting point right now, where we are today, investing on a long-only basis in a credit market, whether it's US, Europe, IG, high yield, gives you a very limited return. And we could say the same for equities, where valuations are expensive, but equities are not bound by this math. Now, the good news is fundamentals are okay because companies have been conservative, both in the US and in Europe. And to some extent, corporate balance sheets are perhaps better than government balance sheets. Portfolios that have a lot of government debt are at risk of inflation, at risk of long end steepening, and at risk of spread widening, especially in areas or term premia widening, especially in areas like the UK or France or the US itself. So corporate credit is tight, but perhaps it's slightly better fundamentally than government credit. Having said that, there is a slow deterioration happening, and that's particularly true in some areas of the high yield market and particularly true in the US. So we do see default rates slowly rising in the future. And what about other markets? What about inflation? What about growth? What do we see for the next year and the coming months? Well, we do see that all this stimulus that's coming to the US, from the US, fiscal and monetary combined, is going to drive inflation to a sticky point of above target, near 3%. And what this means is that there will be less room for maneuver in policy next year should something go wrong, whether it will be an overshoot in inflation, so an overheating of the economy, or a cooling of the economy for other reasons. So we're anticipating a lot of economic gains going into midterm for political reasons and to extend the cycle, but also this means that valuation give you less margin for error and the policy room for maneuver will be lower. We have already seen some discomfort across markets for the amount of loosening that policymakers have input in the economy. For example, in the first weeks of September, we saw the long end widening. The steepening of government curves has put pressure on central bankers to do something about it, to reduce the amount of quantitative tightening, for example. And in the end, long end rates have been kept in check. But should inflation continue to stay above target and potentially rise, then long end rates could be a volatility catalyst in the coming quarters. And it is very important to note that because of all the developments that we have seen so far, in other words, persistent government spending, persistent inflation, the result is that the correlation between risky assets and risk-free assets has become positive. Now, this might seem like a small thing, but it does change the environment for a lot of strategies, including risk parity, including the typical balanced portfolio. So we can't rely anymore on duration as a diversifier, as a risk absorption tool for portfolios. At the same time, real assets continue to appreciate. This is a picture of gold, but in general, we see is that in a financial repression environment, in a debasement environment, we'll continue to see real assets performing better. So what are we doing here? Well, a lot of investors have gone into credit, into a variety of forms, including private credit, including CLOs, structured credit, liquid credit, all sorts of credit over the last 3 years. And pretty much all of them have made money. And the beta and alpha have been mixed. There's a lot of funds had good performance, whether it came from beta or from alpha, including in the long-short space. But right now, with valuations that are historical tight, investors have to be a lot more selective. So in other words, there is a lot of parts of credit which are no longer attractive. They might be better than govies, where governments continue to spend and inflation, is almost the same or higher than government bond yields. So it's marginally better than having, a 30-year gilt or a 30-year OIT. But credit gives you, in many areas, very asymmetric downside to upside. Probably the worst thing you can do right now is to invest in a private credit fund, locking in the lowest level of yields and giving up optionality for 5 years with a beta of 1. What you can do, however, is to have something that's liquid and that's nimble. And I'll tell you what we are doing to navigate this environment. If nothing happens, if the market continues to muddle through like this, if we stay at low spreads, low volatility in a sideways manner, then there is still a lot of dispersion within the market. So there are alpha opportunities because there are sectors that are winners and sectors that are losers in this environment. The winners, for example, in Europe, we have a very large fiscal stimulus and a restructuring of key strategic sectors in the economy, from defense to infrastructure to banks, telecoms, and space. And consolidation is a non-zero-sum game. So it means there will be synergies, there are buyout targets that will be tightening even more or that will be appreciating in the equity market. So there is a large policy stimulus, a large policy effort to improve these strategic sectors, which are big borrowers in the credit market and have been in some ways, stagnant over the last decades. So in Europe, you have this large theme which plays out across several sectors. So there are also special situations around this. At the same time, there are areas of the credit market where several sectors and names will slowly go out of business because they have restructured, but they need to restructure even more. They have kicked the can thanks to inflows, thanks to small haircuts and the availability of credit. But debt collectors that survived with very low interest rate, with very low funding, special purpose vehicle type, levered capital structures will eventually have to restructure. The same is true for industries that are, structurally declining. I mean, if we think about some types of foods, some types of consumer sectors, consumer industries, alcohol, these are sectors that are very challenged and are going to face more deleveraging, more restructuring. So we can talk about winners and losers, but the important thing is that even at a tight level of spreads, there's an interesting churn and there's a lot of interesting themes within the market in terms of winners and losers, especially at the sector level. However, there's also a chance that something might go wrong or something might go right. And I want to talk first about the upside because right now this is where we think the direction of the market will go because of the combination of fiscal and monetary stimulus, which is probably more than warranted given the weakness in unemployment that we have in the US. So where is the best upside? The best upside is not in being long credit, not in being long beta, not in being long, or turbo long credit, which is what some people are still doing. But it's been long instruments that give you more upside than downside. So how do you get optionality to real assets, to sticky inflation, to governments that are spending? Well, it's investing in companies that have bargaining power, that can raise prices together with inflation, or investing in real assets. So for example, convertible debt is now over 10% of our portfolio, and convertible bonds give you upside, sometimes in a cheap way, in an inexpensive way, to companies that are linked to industries that can raise prices. So companies that have strategic position in their sector, companies that have a dominant position or that are linked to real assets, or companies where the government in each country is spending, like defense, infrastructure, materials, mining, and so forth, and real estate. We can structure ways to gain upside to these companies, to these real assets, whether it is in a convertible format, or in an option format. But the important thing is that you want to limit your losses in case the market turns from these very tight valuations. What are the best shorts? What if something goes wrong? What if the Fed stimulus is not enough, or there are external shocks to the economy? Well, then in that case, we think that the weakest sectors will be the bottom 50% of companies, especially in the US and the UK, where inflation is higher and it's hurting the consumer in the bottom 50%. Unfortunately. So some of these areas, some of the cyclical, some of that discretionary spending, and generally some of these tight cyclical credits that are trading at a record tight level for the last 15 years, 20 years, provide an extraordinary opportunity to hedge yourself. It is not something that will be triggered by a few percentage points of sell-off in equity markets, by a small sell-off, but the convexity in a normal sell-off, in a soft recession, in a bump in the cycle, which now no one sees, is extremely attractive. And by no means this means that we are short the market, but we're very aware of where valuations are. And we're very aware that now returns have to come from alpha, not from leverage or beta or carry. So in conclusion, investors are facing a very lopsided, a very tight market. Investors are buying risky assets for capital preservation. Many investors are. And this has created a market that is very tight, is very asymmetric. There was more juice into fixed income assets and into credit over the past 3 years, but now we've gone to near an end of this repricing. Why are investors buying risk assets for capital preservation? Well, because they see that there is a continued sticky inflation rate, and investors want to outperform that. So it is a rational decision. I remember a year ago at a central bank meeting, the central bank asked investors, why are people so bullish on every type of risk asset, from gold to BTP to stocks to real estate? And my answer was, investors are not bullish on all risk assets, but investors are bearish on central banks. And if central bank independence comes into question, then having these real assets is the only way out to essentially teleport yourself into the new regime, keeping your purchasing power, or at least outperforming that inflation or that debasement that might happen. If the US Treasury tonight decides to revalue gold reserves by 50% higher, and as a result, transferring the profits from the Fed to the Treasury decides to spend more, what will be the consequence? The consequence could be, dollar depreciation and the appreciation of all the real assets. So it is rational why investors are buying risk assets for capital preservation in some ways, but continuing to do it right now, especially in credit, is very dangerous. So we continue to think that the West has a debt problem, and that the West will continue to spend at least until midterms, not just in the US, but also in other countries. We continue to see high geopolitical risk, which also means that there is more impetus on the spending side, especially in infrastructure and defense, and there's a lot more difficulty in doing austerity. We continue to see monetary stimulus as a solution to help governments to spend, to make the debt sustainable, and more tolerance to inflation, if not an outright de facto abandoning of the inflation target. What we want to stress, and our message today, is that we've gone to the limit of credit valuations. We might stay there for a few more months, but that it's really important right now to have a strategy that's active, that's nimble, and that can outperform in this environment. So capture the dislocations when they happen, have upside in the right sectors of the market, the right names, but containing losses if the market turns, being at extremely high valuations, and at the same time, optimizing the shorts so that they're not expensive and that the strategy can still have, pretty good returns if the market continues to be in an overvalued state. So our colleagues, very happy to follow up with questions. Please email. Please go on the website for more info on our newsletter, our latest Silver Bullet, which talks about in more detail about what we discussed today. And for anything that you might need, please feel free to reach out to us. And good luck for the rest of the year. Thank you.